Hi, my name is Toxie. I'm the president of Evergreen Anchor Capital. Welcome to another episode in our series titled My Not So Crazy Mortgage. The whole series is geared towards giving you all the necessary information to get prepared before you apply for your next mortgage loan. That way you can get a better mortgage loan options, better interest rates, and a better experience in the mortgage process itself. Today, we'll be talking about the mortgage process and how to understand this process in 7 simple steps. So, understanding the mortgage process. Yes, getting a loan can seem quite complicated these days, especially compared to what it was like before the global financial crisis. Since that period, lots of regulations have been put in place to hopefully avert some of the errors that were made at that time. Of course, with additional regulation requires comes a lot more compliance requirements that have to be met, and that generally leads to more paperwork. And so there's a lot that happens behind the scenes when a mortgage is being worked on, a lot that you don't see. And so I just want to break down in 7 simple steps basically what's happening, what you're going to expect during the process, and hopefully that will help you understand a little bit more what's going on the back end. So, step one. You've watched all our videos and you've done everything and prepared yourself before you applied for your mortgage loan, right? So the very first step is you go and you apply for the loan. That's step one. You apply and you fill out a loan application. Most banks these days have online tools in which you can go in and just fill out your application online. For those of you who don't like to do things online, you should be working with a broker or loan officer who should be happy to take all the information for you over the phone or in person and fill out the application, for you. So you fill out the application, of course, and most banks will require you to submit some supporting documentation to some of the information you put in that application, like your W-2s, your pay stubs to support the income that you put in there. They'll need your credit information because they're going to pull your credit so they can check out your liabilities. They'll need your photo ID to verify the way your name is written, your official name is written and all that, because all the names must match and things like that. That's all part of the application process. Your mortgage banker should be able to walk you through that quite easily. Based on the information in there is where they'll be able to identify what type of loans you'll qualify for. Hopefully you qualify for any type of loan you want, especially if you've been doing all the things that we've been talking about. And that would be the first step. So they would be able to say, hey, yes, Mr. or Mrs. So-and-so, or Ms., whoever you are, you do qualify for this amount of mortgage payment, and they will then finalize that step by issuing you a pre-approval letter. That pre-approval letter is what you give to your real estate professional, so that when they make an offer on a house for you, they'll attach that to it to prove that a mortgage banker has indeed looked at all your paperwork and can, with reasonable assurance, guarantee that you can qualify for the mortgage loan that you are applying for. And that would be the first step in this entire process. So with the pre-approval letter, you went out, you found you had a good time looking for homes, you found the lovely home that you wanted, and then you made an offer and the contract was accepted. That's when you come and step two begins. Step two begins with us getting a contract that now has an address, because everything we did before didn't have a physical property that we were looking at. It was just hypothetical. We were pre-approving you to make sure you qualified. We didn't have the home. But now, in order to have an actual mortgage loan start, you have to have the address of a property. And so once we have that address, the step two is when we'll be issuing out disclosures. So the new regulations indicate that when we've pulled all your information, we've got an address on the property, and there's several other items that we have to have in there. We have to send out disclosures to you within 3 days. Those disclosures are just, they have all the forms in there just to indicate that we are starting a loan with you. They show the type of loan, all the things that we discussed. They have other legal documents, legal requirements in there because, again, based off of what happened after the global financial crisis, regulations were put in place, just to cover a lot of things that people had mentioned at that time, that they weren't aware of when they were going through the mortgage process. And so because of that, to make sure that doesn't happen again, there are lots of documents to sign that explain exactly what's going on. So this set of disclosures is what is sent to you. This is step 2. This is before we can actually even begin the loan itself. Included in that set of disclosures is what is called a loan estimate. A loan estimate replaces what used to be called the good faith estimate back in those days. So the loan estimate has an estimate of the numbers associated with the loan, the purchase price, the loan amount, the fees for the attorneys, escrows, and different things like that. It is just an estimate because don't forget, the loan is just beginning. The mortgage banker that you are working with has only just seen this contract, so there's still a lot of work to be done, but reasonably they'll have some estimates in there that should be close to what will be the final numbers at the end. And so they have to put that in there again so that you can get an idea of what is required of you. So the step 2 is those disclosures being sent out to you. They have to be sent within 3 days. Thankfully, now you can actually electronically sign all those disclosures. A few years ago, they all had to be signed by hand. But now most banks have it set up so that you can have those electronically signed. Once those are electronically signed, your mortgage banker can actually start working on your loan. Step 3 is to lock your rate. Now, even though I call this step 3, it doesn't have to happen right here. It could happen, it could have happened right before the disclosures were sent out. It could happen after your loan has gone into underwriting. But typically here, after when you're starting the loan is when you would discuss with your banker about locking your rate, because whatever rate they had given to you before your rate is locked may not exactly be the same. Rates change all the time. So it's important to really identify that with your loan officer and say, hey, all right, this is the rate we talked about. Can we lock it? We need to lock this rate, because if you wait, the rate it could go down, but it could also go up. So you want to definitely lock your rate at some point. And I think whenever you get a rate that you're comfortable with, you should just go ahead and get that locked and don't worry about it anymore, just so that you avoid the risk of it going higher. So we're gonna call that step 3, but again, it doesn't have to happen at that particular point. It could happen, later in the process as well. But locking your rate is definitely one of those things that needs to be done. And at any point in time, when you lock that rate, you're going to get a new set of disclosures, because anytime anything major is done to your file, you will get a new set of disclosures just to show that you are aware that those changes have been made. No major changes can be done to your loan without you receiving a set of disclosures identifying what those changes are. And yes, so it can be a little burdensome each time there's a change. You lock your rate, you get a new set of disclosures. Yeah, but it's made for your protection to make sure that there's no hanky-panky being done in the background, okay? You are to be made aware if the loan type changes, if anything is added or taken away, you're going to get a new set of disclosures, to explain any major changes with the loan. So once your disclosures have been sent out, and also most likely your rate has been locked, we'll go to step 4, which is processing. This is where the file is now taken up and it's put together, packaged, and sent in to the underwriter. The processor, you could either have, depending on which bank you're working on, you could either have a dedicated processor that all they do is process the file. It could be your loan officer, who is the same person that's processing your file. It could be someone totally different. All banks do it differently. But basically at this stage, they're putting together all the documents that you've submitted, and they're sending that, to underwriting so that it can be reviewed for approval. Also at this stage, most likely is when your appraisal will be ordered. Might be slightly different depending on which bank you work with, but typically that's what would be done. Step 5 is underwriting. So once your file has been sent to underwriting, the underwriter then goes through the entire file and gives it what is called a conditional loan approval. That is, they look at everything and they say, hey, this file is great. We're going to approve this file. In fact, it's approved as long as the following conditions are met. And that's where the underwriter will list whatever things are particular to you that they would like clarification on before they give a final approval. This is step 5, and it actually works hand in hand with step 4 because it goes back to step 4, which is processing. So it goes between the processor and the underwriter until all those conditions are cleared. So what's going to happen is the underwriter is going to underwrite the file, give a conditional approval, and say, hey, I need these items in order to make the file final. They send it back to processing. Processing will reach out to you and say, hey, Mr., Miss, Mrs., Ms., whoever, so-and-so, I need these items to be sent in to me so I can give them to the underwriter. And then once he or she gets everything and submits it back to underwriting, the underwriter will then go ahead and clear the file. That's one of the best things you can ever hear from your processor, is a call saying, hey, your file has been cleared to close. That means everything has been done. They don't need any other documents from you or anything like that. Your file has been approved. That's a phrase that you've got CTC, cleared to close. Step 6 is the sending out of the initial closing disclosure. Now remember, at the beginning of the application, there were disclosures sent that included a loan estimate that had estimates on the numbers associated with your file. Those were just estimates. At this point that everyone has gone through the file, it's gone through processing, underwriting, the attorneys have looked at it and stuff, we're now at a better place where we have more finalized numbers. So an initial CD will be sent out, and that initial CD or initial closing disclosure can be sent just prior to you getting your clear to close or just after you getting your clear to close. And it has to be sent out to you 3 days before we can close your file. And so that's why, you know, the bank will try to make sure to absolutely get that to you as soon as possible. They should have already worked on it with the bank. And so you should have on their numbers that are much closer to finalized numbers than of course at the loan estimate. Hopefully they've completely worked on all the numbers and you have it already done. That's not always the case, but your loan officer will tell you what items may change that have not been finalized yet, but it will be very close to what your final numbers will be at the end. Step 7 is the step that everybody loves, and that's the closing. Once everything has been done, you've gotten your clear to close, you've gone through your initial CD with your banker, who should have gone through, through it with you line by line. Step 7, you attend the closing. You have to be prepared to go sign a lot of documents, but that's always the happy place, right? You get there, you sign all your documents, you get the keys to your house. It's always wonderful. Just prior to the closing, you would have wired the funds that are required. All that would have been listed and given to you by the mortgage banker that you're working with ahead of time. So you attend the closing, you sign all the documents, again, you get your keys, everybody's happy, and that's it. So that's a summary of the mortgage process in 7 simple steps. Again, a lot goes on within those steps in the background that you may not even be aware of. That's the job of the mortgage banker or the loan officer, to make sure everything flows seamlessly and all the hard work is done by us on the back end so that it's really easy for you. That's our job, and hopefully the mortgage process that you enter into next goes seamlessly well and works out just that way.